On the morning of March 9th, 2023, customers of Silicon Valley Bank tried to take out $42 billion. Not over a month, not over a week. In one day, roughly a quarter of everything the bank held on deposit. They did not all get it. The bank ended the day roughly $1 billion short of the cash it needed. By the next morning, another $100 billion was queued to leave. Regulators closed the bank before the market opened. Silicon Valley Bank was not sitting on bad loans. It was the 16th largest bank in the United States, holding $209 billion in assets, most of it in treasuries and government-backed securities. These were among the safest assets in the world. The problem was never what it owned. The problem was when it needed the money. Those bonds were bought when interest rates were near zero. When rates rose sharply, older low-interest bonds were worth less to anyone buying them today. Held to maturity, they would have paid in full. Sold early, they sold at a loss. The bank had promised its depositors money on demand and put that money into assets that only made sense if nobody asked for a long time. On March 8th, the bank sold some of those securities early and booked a $1.8 billion loss. It announced the loss alongside a plan to raise fresh capital, intending to reassure. Everyone did the arithmetic instead. On March 12th, the Treasury, the Federal Reserve, and the FDIC acted together. Deposit insurance normally covers $250,000 per depositor, per bank. They invoked an exception and guaranteed every deposit above it. The same day, the Federal Reserve created a new lending facility to stop this happening elsewhere. Banks could pledge the same underwater bonds that had just destroyed Silicon Valley Bank. The Federal Reserve would lend against them at full face value rather than lower market value. The bonds themselves were unchanged. What changed was what the Federal Reserve was willing to lend against. Note what did not happen here. Nobody lied. No statement was false. No regulation was broken. The bank may have been solvent in the long run. The problem was that its depositors wanted their money first. The promise still could not be kept because the promise was never about solvency. It was about time. Most people believe a bank holds their money. In law, a thing you hand someone for safekeeping stays yours. Leave a watch with a jeweler, and it is still your watch. Banking could not exist under that rule, so a different rule was built for it. In 1848, the House of Lords settled the question in a case called Foley versus Hill. The court looked at what bankers actually did with money paid in. They treated it as their own. They lent it out. They kept the profit. So the law followed the practice. The relationship was not safekeeping. It was debtor and creditor. Money paid into a bank stops being the depositor's property. It becomes the bank's own money. What the depositor holds in return is a promise of repayment, nothing more. That legal structure is what allows a bank to use deposits to make loans. United States courts adopted the same principle. It has stood ever since. So, the account balance on your screen is not a receipt for stored property. It is a claim against an institution that has already lent the money elsewhere. That is not a scandal, and it is not hidden. It is simply not what most people think they agreed to. Which raises an obvious question. If the promise has always been this fragile, why did it hold? Not because depositors could not run. A bank run is simply what happens when too many depositors demand their money at once. America saw 5 major banking panics between 1873 and 1907. 2 institutions answered them. First, a central bank willing to lend against almost anything worked out in Britain in the 1870s. Then, in America, deposit insurance in 1933. Both of them work. Both of them need time to respond. In September 2007, British savers queued outside Northern Rock in the first run on a major British bank since the Victorian era. The website went down. The phone lines jammed. But it took days, and days were enough. There was time to convene, to lend, to guarantee. At Silicon Valley Bank, 94% of deposits were uninsured, above the $250,000 limit. And the depositors were not strangers. Venture capital firms warned their founders in group chats. The founders moved the money from their phones. There was no queue to answer. A quarter of the bank was called for in a single day, and the rescue could not be assembled until the weekend. Both institutions were built for a bank run that takes days. Neither is built for one that takes hours. Every fix in this story required someone to intervene, a guarantee extended past its own stated limit, a facility invented over a weekend, a price declared rather than discovered. So the question worth sitting with is not whether those decisions were wise. It is simpler than that. What would you hold that nobody would have to rescue and nobody could reprise by announcement? This is the Cantillon Letter. Monetary truth. Understand it first. Subscribe and visit us at cantillonletter.substack.com.